Hey investor friends, I'm Michelle Marki, and let me ask you, what is your understanding of risk when it comes to investing in stocks? Because if you go with the mainstream version, it would have you believe that the risk in investing in stocks comes from how much a stock's price moves up and down, and that's called volatility. So there's some notion, especially in academia, where the more that a stock is volatile, the more risk it might have. And this idea has actually been dispelled by the best investors of all time, known as Warren Buffett and Charlie Munger of Berkshire Hathaway. And they explain how they look at risk in terms of business risk, like when you're actually investing in a business and expecting to get some level of return, what risks you can expect, and also some psychological risk, as they explain in the following 1997 Berkshire Hathaway Annual Meeting about how we can really think about risk and not the standard definition of risk that academics usually like to propagate. And Buffett explains why their idea of risk is actually really different and why you can think of volatility as more of a friend rather than a foe when it comes to investing in stocks. So if that sounds good to you and you're looking forward to buying a lot of wonderful company stocks on sale, especially the more volatile the stock market gets, please be sure to like and subscribe to my video and YouTube channel, and let's listen to Warren Buffett and Charlie.
In light of recent stock market volatility, could you give us your definition of stock market risk? And how does your definition differ from the standard definition? Finally, due to Charlie's recent counter-revelation about jets, are you going to rename the indefensible?
Charlie would like to make an announcement on that second point.
Prompted by Al Ochi, we are changing the name of the company plane from the indefensible to the indispensable.
It was Chateaubriand, who incidentally was a writer and philosopher in addition to being the father of a piece of meat. Chateaubriand wrote one time, I believe I'm correct on my attribution here, that events make more traitors than ideas. And if you think about that in terms of Charlie's remark, that the purchase of flight safety caused Charlie to have this counter-revelation. And it's an experience that is duplicated many times in life where people flip over very quickly to a new view based on their new circumstances. Now, what was that first question again?
I might add that I have a friend who's a United Airlines pilot, and he has recently been promoted into the 747-400. Before he started carrying people like you around for hire, he had to train intensively for 5 weeks. 100% of his training was in a simulator. They're that good. So
they better be that good. They cost us about $19 million, but they're fabulous. I mean, if you think about it, I think it's 85% of the problems that you can encounter in a plane. If you attempted to teach people by actually being in a plane, they wouldn't be here anymore. So you want to develop the instincts and responses that can react to 85% of the problems. The only place to learn them is in a simulator, and probably the other 15% the best place. Now let's go back to your first question. Give it to me again.
The first part was, would you give us your definition of stock market risk and how it differs from the standard definition?
Yeah, we don't think in terms of, well, we think first in terms of business risk. The key to Graham's approach to investing is not thinking of stocks as stocks or part of a stock market. Stocks are part of a business. People in this room own a piece of a business. If the business does well, they're going to do all right as long as they don't pay way too much to join into that business. So we're thinking about business risk. Now, business risk can arise in various ways. It can arise from the capital structure when somebody sticks a ton of debt into some business, and so that if there's a hiccup in the business, that the lenders foreclose. It can come about just by the nature of the business. Certain businesses are just very risky. Back in when there were more commercial aircraft manufacturers, Charlie and I would think of making a commercial airplane, a big airliner, sort of as a bet your company risk, because you would shove hundreds and hundreds of millions of dollars out into the pot before you really had customers. And then if you had a problem with the plane, the company could go. There's certain businesses that inherently, because of long lead times, because of heavy capital investment, that basically have a lot of risk. And commodity businesses have risk unless you're the low-cost producer, because the low-cost producer can put you out of business. Our textile business was not the low-cost producer, and we had a fine management, and everybody worked hard. We had cooperative unions, all kinds of things. But we weren't the low-cost producer, so it was a risky business. The guy who could sell it cheaper than we could made it risky for us. So there's a lot of ways businesses can be risky. We tend to go into businesses that inherently are low risk and are capitalized in a way that that low risk of the business is transformed into a low risk for the enterprise. The risk beyond that is that even though you identify such businesses, that you pay too much for them. That risk is usually a risk of time rather than loss of principal, unless you get into a really extravagant situation. But then the risk becomes the risk of you yourself. I mean, whether you can retain your belief in the real fundamentals of the business and not get too concerned about the stock market. The stock market is there to serve you and not to instruct you. And that's a key to owning a good business and getting rid of the risk that would otherwise exist in the market. You mentioned volatility. It doesn't make any difference to us whether the volatility of the stock market averages 0.5% a day or 0.25% of a day or 5% a day. In fact, we'd make a lot more money if volatility was higher, because it would create more mistakes in the market. So volatility is a huge plus to the real investor. Ben Graham used the example of Mr. Market. We've used it. I've copied it in the report. I copy from all the good writers. And Ben said, just imagine that when you buy a stock that you bought into a business where you have this obliging partner who comes around every day and offers you a price at which you'll either buy or sell, and the price is identical. And no one ever gets that in a private business where daily you get a buy-sell offer by a party, but in the stock market you get it. That's a huge advantage. And it's a bigger advantage if this partner of yours is a heavy drinking manic depressive. I mean, the crazier he is, the more money you're going to make. So you should, as an investor, you love volatility. Not if you're on margin, but if you're an investor, you aren't on margin. And if you're an investor, you love the idea of wild swings because it means more things are going to get mispriced. Actually, volatility in recent years is dampened from what it used to be. It looks bigger because people think in terms of Dow points. So they see these big numbers about plus 50 or minus 50 or something. But volatility was much higher many years ago than it is now. And you had the amplitude of the swings was really wild, and that gave you more opportunity. Charlie?
Well, it got to be the occasion in corporate finance departments of universities where they developed a notion of risk-adjusted returns. And my best advice to all of you would be to totally ignore this development. Risk had a very good colloquial meaning a substantial chance that something would go horribly wrong. And the finance professors sort of got volatility mixed up with a lot of foolish mathematics. And to me, it's less rational than what we do. And I don't think we're going to change.
Yeah, well, finance departments teach that volatility equals risk. Now they want to measure risk, and they don't know any other way. They don't know how to do it, basically. And so they say that volatility measures risk. And I've often used the example that the Washington Post stock, when we first bought it, had gone in 1973, had gone down almost 50% from a valuation of the whole company of close to, say, 180 or 175 million down to maybe 80 million or 90 million. And because it happened very fast, the beta of the stock had actually increased, and a professor would have told you that the company was more risky if you bought it for 80 million than if you bought it for 170 million, which is something that I've thought about ever since they told me that 25 years ago, and I still haven't figured it out.
And so after listening to Warren Buffett and Charlie Munger explain their understanding of risk, the moral of the story is that risk is not equal to volatility, and also risk is more so equal to if you might suffer permanent loss of capital in your investment. Like if after you've studied the business fundamentals and the business just continues to not do well, like how Berkshire originally started out as a textile factory and then that gradually went out of business due to overseas competition. So based on the fundamentals, Buffett's investment was at risk because the business itself was declining in its quality and wasn't able to generate as good of returns on its assets anymore. So if you realize what true business risk is, you can make better informed decisions about an investment and maybe try to avoid investing in industries or businesses that could be on the decline, or industries that you just don't understand well enough, like the latest innovative technologies that maybe they might seem really attractive with their startups and with IPOs coming out, but if you don't really know where the future of the business could really be going, then that is ultimately one of the bigger risks, rather than just whatever the stock price might be. And if you've studied a business and its fundamentals are good and they're continuing to generate a lot of positive free cash flow, and yet their stock price continues to go down, maybe that's a signal that you should actually buy the stock like Warren Buffett has done over many decades. And that's how he's ultimately proved to be one of the best investors at this. So instead of listening to the academic standard version of whatever risk might mean, it's really hard to know what risk it really is and how to truly measure that, but you have to just do the best you can, because some other investors like Howard Marks believes that we might not be able to truly measure risk. So a lot of this is really just coming down to an educated guess as to what risks there could be when it comes to a stock market investment. And also, you should be on the lookout if the stock market continues to go down and we have a lot of volatile moments. Like there may have been some stock market buying opportunities in July and October this year when the stock market VIX, or volatility index, reached into the mid 30s, and it might be a really great stock market buying opportunity if it goes even higher, like back in 2008 when the VIX reached about 80. That may have been one of the best times that you could have invested in the stock market, because if you look back on, say, the S&P 500's performance since 2008, it's been up. So even though we haven't quite reached those kinds of lows again, the more that the market could be at risk with the Federal Reserve hiking interest rates and a potential recession coming along, that might mean that there could be even better stock market buying opportunities the more volatility we see. So if you believe Warren Buffett and Charlie Munger, you will actually be excited the more that the stock market is volatile, and not feel like your investments are that much at risk if you've done your homework and invested in the very best companies or funds that are pretty decent, like the S&P 500 index fund. So you can't go too wrong if you go with some of those strategies that Warren Buffett puts his money and mouth behind. So if you found this video helpful and enjoyed it, please like and subscribe. And I wish you well on your journey to getting through whatever riskiness there could be in the markets and ending up on top in the end. Till next time.